Hi, good afternoon, everyone, and thank you for connecting on PL Asset Management Strategy Call today. I thank all participants staying tuned for some time where others were already logging in. Just to start our conversation, past 6 months have been nothing worse than this could have ever happened, right? You had a trade war, you have a war in air, probably tariffs, all kind of restrictions, geopolitical tension. We had a tension with our neighboring countries, and recently we saw probably an airline crash as well. So the things in past 6 months have been unfold in such a way where a lot of news events and all around those events, the sector rotation, the stock rotation, we saw crude going high. Again, we saw some sort of volatility in commodity prices and a multiple things that have happened in just less than 6 months. Despite of all this, we saw good interest from investors in financial markets. We are seeing maybe even a corporate earnings also went through a lot of turbulence. Our quantitative models that what we have set and obviously with change in volatility, there are certain structural changes that also underwent with us as an asset management company also. We had to deal with investor sentiment completely when there were multiple uncertainties, when the tension with our neighboring countries escalated. Mm. I'm happy to share with every one of you that probably just a week back we completed 2 years of the absolute live performance of our flagship quantitative strategy as an AQUA. We had different time frames of the investing. During the call, Siddharth will take you all through these different time frames, how we have done, what kind of returns have come up, how strategies have shaped, and what processes and the systems have changed even within our quantitative investing. What is most important that you all need to know is that what happened in past, how our con models are geared up today, and what you can expect from this strategy going forward. Obviously, every one of you are looking for a substantial alpha that the strategy should create, and we as a company are definitely committed towards generating that sustainable alpha. About the processes, what sector allocations we have done. We have also seen a lot of differentiation in the sectors, some rotations within the sectors. We were very heavy on financial probably a quarter back. Now we have moved towards some industrials and changes, so on and so forth. With this, I would suggest my colleague Siddharth to take this call forward, discuss with you guys about our models and the changes. If you guys have any question, just put it in a chat and Q&A, and probably we'll be happy to take those questions, or you can raise your hands and we'll allow you to ask the question. Over to you, Siddharth, on the strategies and the processes. Thank you.
So thank you so much, and good evening, everyone. Today, I'm just going to take you guys through everything that we're making of the markets, or what are we doing in the portfolio, what is the road ahead looking like, which part of the market cycle are we currently in. Let's go through all of that, piece by piece. I think it's important. To start with the market overview, I think it's a mixed market, as we know. A lot of positives from the macro standpoint, whether I look at GDP numbers, PMI, inflation making record lows, the rate cut from RBI, the liquidity infusion, forex reserves, GST collection, domestic SIP book making new record highs every month despite the volatility in the markets. DXY coming sub 100 and sustaining there for a continued period of time. The Baltic Dry Index again showing freight activity is solid. Very good monsoon projection for the next 3-4 months, and the credit rating upgrade that India got. So I think a lot of positives here for India, bulk of which seem to have been priced in the short term. From a valuation standpoint, I think there is limited room for multiples to expand meaningfully from here, especially in the mid and small cap. Large cap, I think is a little reasonable, and we could see some meaningful upside there. Mid and small cap, rather than a broad-based rally, we would perceive a more sector or stock-specific re-rating rather than a broad rally that we saw over the previous cycle. Another important thing to understand here is that after a 4-year clean bull market, we finally see that breadth collapsed from October to March. So October, November, December, Jan, Feb. 5 months where the breadth collapsed very, very significantly. Almost 80-90% of markets had a negative breadth. Now we are seeing a revival in breadth, which is a healthy sign. Foreign flows could remain choppy and volatile. As I said, there are a lot of positives, but also some major global negatives uh, in terms of crude, in terms of geopolitical stress in multiple pockets of the world, China being a strong contender for growth and for capital flows, the tariff-related uncertainty. I think we should be in a range-bound market with a slightly positive bias. Market conditions will remain healthy, but you will see some sort of minor corrections on the way in the next couple of quarters. So the bias and the direction is definitely positive from here, but we don't see a very large upside, at least on the broad index level. We see markets can be in a more consolidative space, and that's a decent time for strategies like ours to capture alpha. Last month, we captured roughly 1%. This month, we've captured roughly 2% alpha. So narrow markets with concentrated factor positioning, the way we are building our portfolios, could help in capturing alpha in this phase of the market. Uh, Overall, I think markets don't seem to be in a panic mode anymore. Whether it's domestic investor sentiment or global investor sentiment, markets have shown a lot of resilience despite a lot of negative events. Uh, Understanding market phase is important because it helps us anchor our expectations in a more realistic way. And as we know, long-term expectations had always been in the 13 to 15% range for bulk of the equity asset class till 2020. This saw a major shift post 2020, where expectations went up in the 25 to 35% compounding range. So I think despite the positive tone that we can see in the markets, the expectation in terms of return must be more closer to long-term averages rather than closer to the short-term averages. A couple of things we understand from the market cycle itself. I think these three charts give you a good insight of where we are in the current part of the cycle. So if I look at, the first chart, it tells us percentage of stocks which are near the 52-week high versus those that are near the 52-week low. So if we see middle of 2024 onwards, this indicator started peaking out all the way till the beginning of March, where it sort of contracted and came to its cyclical trough. In my previous webinar, I had indicated very strongly with a lot of conviction that this is a multi-cycle low and markets could only recover from here. And fortunately, it has played out exactly the way we wanted it to. After a very sharp correction in the sentiment index, we see a good revival in the sentiment index of India. And I think that's a good sign. And there's still some time till we hit back to the peaks of the previous cycle. So there is some upside left, not maybe as much as we saw in the previous cycles. Another indicator we look at to gauge where the markets are is the Nifty equal weight versus Nifty 500 return spread. Again, when Nifty equal weight does well, it tells us that there is broad breadth in the market or the breadth is improving. Nifty 500, on the other hand, is a more market cap focused index. It's dominated by large caps. 65-68% is large caps. So we are seeing that this indicator also sort of peaked out somewhere in middle of 24 and has continuously corrected. Now it is stabilized for the last 2 months and is finally on its way to recovery. And a similar picture is also painted by the percentage of stocks beating the 12.5% mark per annum return. The reason we choose 12.5% because that's the median long-term Nifty return. It's in the 12-13% range. So how many percentage of stocks in India are beating that over a yearly basis? Again, this is a great market phasing, market cycle tool. We can see in up cycles, this indicator trends up and stabilizes at higher levels before it sort of contracts and then restabilizes at lower levels to turn back into the next cycle. So as we see, I think bulk of the froth and pain of the previous cycle that was built up has corrected. Markets have stabilized and are now building up for the next long rally over the next 3 to 5 years. So investors should stay positive, should stay confident, and should stay invested through all these cycles of the market. Drawdowns, sharp returns, moderate returns, all of it is a part of the market cycle. We've experienced it. You all have experienced it. In our fund, we've seen a phase where we've done phenomenally much better than benchmark and peers. Probably some other funds lagged. Then we consolidated in line with benchmark. Other funds also were in that same range. Then we saw a sharper drawdown. Probably some active funds did better. Now we are seeing a very strong recovery as well over the last 2 months. So again, we are coming back to two facts of the strategy that the back tested long-term return of this strategy was in the 25 to 28% mark over 3-year, 5-year, 10-year cycles. My live return is also closer to the 26.5% mark since inception. That's an alpha of roughly 6.5-7% versus the benchmark. The other statistic that our fund is going to be subjected to is the quarterly outperformance ratio. So since 2006, we've beaten the market on a quarterly basis roughly 68% of times, which means 32% of quarters we underperform, 68% of quarters we sort of outperform. And we've stuck to that statistic even in the live fund environment. Yes, we've had a bad quarter. That's behind us. We're currently in a good quarter. Both last 2 months we made solid alpha, and by the time we close June, July, we should have covered most of the alpha. We now are lagging the benchmark just by a 1% margin for the quarter. So we should be able to cover that up in the next few days, given the portfolio positioning and the way we are monitoring its daily performance. We think we've got this month's positioning sort of right, with a focus on cap goods, with a focus on IT, with a focus on metals, with a focus on capital marketplace. I think that whole theme is playing out well for AQUA. Even from a valuation perspective, important to understand that when we look at the long-term Nifty PE range and look at the forward returns post that, it's important to see that every time we enter markets in a moderate PE zone, we tend to make much better returns. So again, this is going back to the basic philosophy of greed and fear. Every time markets are in panic, there's a sell-off, there's a sharp drawdown, investors think of pulling out rather than topping up and adding more funds. Even this cycle is no different. Markets did give us a chance to add funds in the green zone. As your fund manager, as your counselor, I've also, in my previous webinars highlighted with a lot of clarity that we are at cyclical troughs and the cycle is about to turn. Good time to add funds, good time to stay invested, worst time to get out of the markets. Again, sometimes emotion takes over rational decision making, and we saw that sort of play out here. If you look at the green zone that the markets offered us just 3 months back, it's been a very, very good entry point for investors. There were a few wise investors who topped up in that phase and have recovered significantly from that point. But having said that, we need to understand adding funds at peak cycle is usually not a prudent strategy. And we've seen that play out time and again. Multiple episodes where markets have been elevated, the next 12-month returns seem to be slightly more moderated. In phases where market seem to be not so elevated from a valuation standpoint, the rolling 12-month return is usually much better. So I think one should keep this in mind. And again, we're not in a death zone yet. We still have some upside room, not too much, but some upside room from here. From a small cap and large cap perspective, again, we believe large caps offer a little more value than small caps, and small caps are trading above their long-term averages and medians. Again, we do have some room for further re-rating, but not too much. So need to understand that valuations, while not uncomfortable, are not very lucrative as well. A good 12-13% recovery has already played out. It could have also played out in 6-12 months, but it sort of played out in 2-3 months only. So there could be some sort of consolidation before the next move begins. Even some of our quantitative indicators are saying that the risk appetite is back into markets. Whether I look at the Nifty high beta to Nifty low vol index, that spread also tells us that high beta is making a comeback. Even equity to gold spreads are saying that equity is likely to make a comeback. This is more from an Indian equity perspective. Even when I look at style cycles, we are seeing that momentum is at a cyclical trough and is recovering much better. So the next 12 months, we could see some momentum in the market. Small versus large spread also suggests that small caps have now become less expensive as compared to their own history. So while this could take some time to recover from a 5-year cycle, small cap allocations could be making a lot of sense at this point. Even from a value quality standpoint, we believe, value cycle might be nearing its end and the quality cycle might begin from here. Again, this is to show you that factors and styles perform in cycles. So every few years, the orientation sort of changes. And a live example, if you look at 3-year cycles, so 2007 to 10 was the value cycle. Then we saw dividend cycle, dividend and momentum cycle. Then again, we saw momentum cycle. Then we saw cyclical high beta sectors do well in the next phase, followed by momentum and large caps. In the next cycle, again, we saw momentum doing really well, and we saw small caps doing really well. And again, after that, we've seen value do well, quality doing quality not so well, and momentum doing well. So again, the rotation from value, momentum, dividend, quality, we keep seeing that over and over cycles. It's important to understand that while these factors might play out well over a cycle, there could be shorter phases where these factors underperform. Another important thing is to understand, again, yearly annual cycles. Just the color coding of this chart will tell you that not every style factor, not every investment approach will yield positive returns every single year. And therefore, we have taken a multi-factor approach, and within that, a dynamic multi-factor approach. The multi-factor approach gives us a blended benefit of multiple styles rather than trying to get just that one style right, which might do well in the next 12 months. So again, the idea is that factor rotation is critical for alpha generation. Factor rotation is critical for risk management. 10 out of, over the last sort of 20 years, every time we've tried to manage risk in sharp drawdown phases, we've succeeded 12 times, we've failed 8 times. So we have a 60% probability in terms of managing risk in phases of sharp drawdowns. If I also look at, how active, passive, and factor approaches do over a long cycle. Again, from an investor perspective, very important to sort of stay diversified across the 3 approaches rather than bet heavy on any one. There are cycles where passives will do much better. There are cycles where factor funds will do much better. And then there are cycles where active funds will do better. The last 12 months saw active funds do better than passive funds, and factor funds were in line. In the previous cycle, we've seen 2018-19 as 2 years where factor funds or quant funds trailed and active passive did much better. So over a 5-10 year cycle, we believe, and data suggests, that factor funds have a higher probability of outperformance because they are systematic, because they are rules based, because they are data driven. Of course, no strategy or no style will perform well every single year. So even within phases of outperformance and underperformance, we could see 4 or 5 years where factors do less good compared to actives and passives. So the prudent approach is stay diversified across the three approaches, stay invested, and ride the entire cycle rather than try to time the cycle of when which approach will do better. Even within AQUA, our essence is based on the phase of the market, whether we're in a bull phase, a correction, a bear phase, or recovery, we are trying to tweak the factor weights. We're trying to adjust the portfolio alignment in order to navigate that phase. June 23 to sort of June 24 or July to July, that 1 year cycle, we were in a bull phase. We were focused on value momentum. We did 78% returns versus Nifty 25 and BSE 536. So we captured a lot of alpha, 2x, 3x alpha versus indices. In the consolidation phase, we sort of trailed. We were down 1.5%. Nifty was down another 1.5%. So we were in line. It's the 1 quarter between Jan Feb, which cost us a lot of alpha. And that is the phase. Despite having our guardrails up, we could not protect alpha in that part of the cycle. So we were in low beta sectors. We were in low volatility stocks. We were in decent to high quality stocks. Despite that, FMCG, IT, pharma, healthcare, bulk of these sectors, which are traditionally considered defensive, also corrected sharply in that phase of the market. Important to sort of understand that in the months of Jan and Feb, when we saw a correction or a sharp correction before the recovery now, all factor funds or all factor indices also saw sharp corrections. Just to put perspective to this, say in a month of Jan when we were down 10.5%, momentum was down 19%, value was down 14%, growth was down 15%, low vol was down 4.5%, quality was down 8.5%, dividend was down 6.5%. So multiple different factors corrected very sharply in the month of January. And because we had a blend of factors with a tilt towards quality and low vol, our corrections were in closer to the quality low vol spectrum. But because we also had some allocation to value, momentum, and growth, we were at the 10.5% mark. From a factor construct perspective, from a factor timing perspective, we try to blend factors and go overweight factors where we see better risk reward. Most of the times, this factor construct plays out. Sometimes it doesn't. And if you look at, the January quarter, Jan to March quarter, that was one sort of outlier quarter within all the quarters that we've been around. Before that, you can see a clean streak, winning quarter, winning quarter, winning quarter, winning quarter, inline quarter, outperforming quarter, and then one very bad quarter where we lost a lot of alpha. So like we could have multiple winning quarters, we could also have a bad quarter. And if an investor stays invested for roughly 3 to 5 years, all of these kind of phases will keep arising in the market where we see inline quarters, bad quarters, and fabulous quarters. Our agenda is to be more than 65% in the fabulous quarters to cover up the alpha. And another important thing to understand here is if I look at my performance phase-wise, in bull markets, we did very well, 76. Sideways market, inline. Bear market, we trailed big time. Recovery market, again, we've recovered quite well. And we are continuing. This is slightly dated, but our recovery phase returns are closer to 13.5% versus benchmark at 13.8%. So we are broadly in line on the recovery side of things. Even when I look at my performance versus category means and medians, one would find that if I compare quantitative strategies to AQUA, there are cycles where AQUA has stayed significantly ahead of the category mean and median. And then there is a phase where again, we've been in line with the category mean median. So it's important to understand AQUA's performance from quantitative categories performance itself. I think one quarter was a little bad here in terms of trailing versus these 2 quarters. We trailed the category, but not the benchmark. And this quarter, on an absolute basis, we were not good, but we were in line with the category median. If I look at the current quarter, we are again 4% ahead of the category median. So again, it's all part of the cycle. Every phase will offer you some risk. Every phase will give you a different exposure to our factors. Our idea here is when we compare ourselves to the benchmark, we need to see how consistently are we able to beat the benchmark. If I compare myself to quant as a strategy itself, how am I doing versus other quant funds? And then the third decision is how is quant as a category doing versus active as a category in the same period? Very important to understand that, in this quarter, Q2 FY24, quant led active. Again, in Q3, quant led active. Q4, quant led active. Q5, quant in line with active, I would say. Again, the next quarter, in line or better. After that, we start seeing quant trailing. So there were 2 quarters where quant as a category trailed active funds. But again, if we are seeing now, quant is again catching up. So 0% is the quant median versus 1%. So as this next phase starts, again, we see quant as a strategy reviving. I explained you from a 20-year cycle perspective, and I'm explaining you from a 8-quarter cycle perspective that quantitative strategies are based on pure data, factor data. If the data is chaotic, quant strategies could underperform in the interim. Active managers will lead when decision making about future or uncertain periods is under question. Quant will lead when there is clarity, there is more certainty in the markets. And over a 20-year cycle, we've seen that there are a lot of times where markets are in a clear trajectory, in healthy conditions. Then there are some times where markets are not so healthy. And then there are some times when markets actually correct very sharply. In sharp corrections which sustain over a year, or in sharp rallies which sustain, quant will do well. But in chaotic, choppy, short-term volatility, quant can underperform. As an investor, one needs to understand the risk-reward profile of quantitative strategies, of active strategies, of passives, and their role in diversifying your stream of returns, in diversifying your streams of risk. When is quant able to manage risk well? When does quant trail? When is quant able to capture a lot of alpha in a bull market? When does quant start of consolidate in a sideways market? All of these are considerations one must understand while staying invested. Even if I look at how we've rotated the portfolio in terms of beta, in the bull market, we maintained a very high beta, which was gradually rising. Then we sharply reduced the portfolio beta into FMCG, telecom, defensive sectors like IT, healthcare, utilities. While our beta call was right, somehow the sectors with low beta also underperformed in this correction. Now, as the markets have stabilized, we are gradually again increasing our portfolio beta over the last 3 months. And the benefits of this can be seen in your life portfolio returns as well. Even if I look at my alpha, yes, we made a lot of alpha in the previous cycle. Then we lost alpha over 3-6 months. And now we are recovering alpha once again, as is visible in the alpha recovery chart. Some stocks that have played out very well for us over the last couple of months, I've just sort of highlighted a couple of names. MCX, AB Capital, Mazgaon Dock, Bajaj Finance, Chambal Fertilizers, ICICI HDFC. Some of these names have given us good returns in the last phase while keeping volatility under check. Some exits that we've made, and I think the exits played out very, very well for us. A lot of times, investor question, why did you sell a stock at this price? Why not 10 rupees higher, 5% lower, 5% higher? Again, our sell decisions are model driven rather than, having a view, okay, this stock can go up 50 rupees more, let's sell it at the peak. We don't time exit to that level of precision. We take a broader call on factors, on portfolio beta, on sectors, and our entry exits are a function of that. Just to give you a couple of examples. So Chambal Fertilizers, we exited, we booked 28% returns. After we exited, the stock corrected 23%. Similarly, Indian Hotels, we exited at break even. We were neither up nor down. We did hold the stock for a while, but we exited at a break even. Post our exit, the stock corrected 18%. Like this, there are multiple examples that somebody could say, okay, why would you exit Godrej Agrovet or Amber Enterprises at a drawdown or in negative? After our exit, the stock has corrected significantly. So our idea is always to try to manage risk, rotate the portfolio, and stay aligned to the market. Similarly, in the cement pack, Ultratech and Shree Cement, we booked some profit, maybe not too much, but 3-6% profit. And post that, the stocks corrected 7% more. So there was a delta of roughly 10% on Ultratech and roughly 12% on Shree Cement. So it's important to understand that some exit decisions that we make, there is a rationale behind that. We get it right sometimes, we don't get it right sometimes, but it's important to understand that there's a model working behind all these entry exit decisions. After a long time of staying in quality and low vol, we are finally seeing a change in the market regime. We are moving towards growth. We are moving towards momentum gradually. So the shift from value to quality and quality to growth, this is what we've seen over the last sort of 24 months. Sustained phase of value, then transition, then continued phase of quality, and now growth. Similarly, from a technical perspective, we saw sustained phase of momentum, then transition, sustained phase of low volatility, and now yet again transition. Important to understand that as market regimes change, we need to align and rebalance our portfolio to capture the essence of the current cycle. Even if we do this with a 65-70% sort of hit ratio, over a cycle, we make a lot of alpha for investors. Again, important to see the dynamism of the strategy in the various phases of the market. The early cycle was concentrated and dominated by small and mid allocations. Post that, we saw a balanced allocation approach where mid caps were dominating and small and large were sort of taking the lower allocation. Post that, we saw large caps rise significantly, small caps reduce significantly, and we currently have a more large and mid orientation rather than a mid and small orientation. So across cycles, we can see how we've dynamically not just changed our market cap allocation, also managed cash dynamically. Some cycles, our cash management has yielded beautiful results. Some cycles, it did not work out. But overall, since inception, our returns are closer to the 26% mark as opposed to benchmark at 20% mark. That's a good 6% alpha. The similar narrative can also be conveyed from the average portfolio market cap. Again, we've seen portfolio market cap was lower for a cycle. It increased, it sort of normalized here with mid caps taking bulk of the allocation and then meaningfully increased and continues to stay on the higher side this time, given the valuation comfort and risk reward that we perceive in large caps and mid caps as opposed to small caps. This is just to show you over the last 100 days, what kind of cash allocations have we had and how we've done on bad days in terms of Nifty returns. So this is just a simple chart to show you our cash levels with Nifty drawdowns on a daily basis. This has kept our volatility low. This has kept our beta low. This has helped us capture at least 2% alpha on down days in aggregate, which means we've built a lot of alpha by falling less than the market in this phase, as opposed to just capturing alpha on the upside. We are also capturing alpha on the downside. Currently, as we see, financials, which include insurance, capital markets, lenders, and banks, they constitute a significant part of our portfolio, followed by materials, mainly dominated by metals, followed by IT. These are and industrials. These are our top 4 sectors. Some of the other sectors have more marginal allocations. These allocations are likely to change in the near future as we see more evidence of sector rotation in the market. But currently, this allocation is playing out very well for us. IT and metals were the two tail risk sectors we had kept in the market, which were the two globally exposed sectors. If we saw revival in the global economy, if we saw the tariff situation play out better than the market expected, if we saw US economy getting stronger than we originally thought, if we saw our exports getting stronger, if we saw dollar weakening, some of these sectors would contribute meaningfully on the upside despite being largely ignored sectors. IT is performing well because the worst is already priced in. It is a traditionally low vol sector. And in this phase of the market, where some other sectors have run up, this is the only major sector with relative value, lower volatility, long track record of quality, and improving global cues. So, having said that, the IT sector allocation played out really well in the last 2 months for us. Same for metals. A couple of other things, I would like to take investors through. Some of the major changes, which we've been working on in the portfolio. So as I said, rather than doing a binary 50-0 cash call, we've introduced a dynamic cash management model, which helps us transition from zero cash to some cash to higher cash based on market risk. Instead of doing the entire rebalance on one date, we've staggered our rebalancing over a period of 4 months, where periodically, dynamically, we rebalance the portfolio using rebalancing triggers. Instead of doing it over one day or 1 week, we separate it out and stagger it across a period. We do it in tranches. Instead of having predefined factor weights, we've taken a dynamic smoothened factor weighting approach where factor weights change gradually over a cycle rather than sharply over a month or 2 months. We've also introduced churn control mechanism going ahead, and already you are in the last 30-40 days and going ahead, you will see much lower churn in your portfolio as opposed to what you've seen in the past. We've expanded the portfolio to a 30 stock portfolio from a 25 to 30 earlier to enhance diversification and reduce idiosyncratic risk. We've also worked on a model that helps us capture market extremes and go into at least 10-15% cash on extreme markets. And we've also introduced algo-based execution to improve execution efficiency. These are some of the more meaningful changes which we've introduced while we continue to work day and night on other features to improve the strategy, improve the model, maintain our edge. These are some features we've introduced already. And over the next quarter, we will see another 3-4 major enhancements that we are planning in AQUA. Happy to, take up questions at this point of time.
So there's a question related to the churn in the portfolio. We completely understand that there has been concerns related to the churning by few investors. But considering the current volatility of the markets and the way before we started this call, I explained every one of you all that what kind of time frame in last 6 months the tariff war to the geopolitical tensions and then tensions with the neighbors, that what we have seen. One need to understand that if we don't align the portfolios with this changing trend and changing market, it becomes very difficult to generate sustainable alpha. Having said that, the recent models introduced by Siddharth and his team, we are confident that the churn ratio in next few months will come down substantially. If he has to add anything, I'll leave it up to him.
Yes. So I think understanding churn, you need to understand a couple of things. The basic raw material for any quant strategy is data. In a certain cycle, data itself is so chaotic. Factors don't persist, sectors don't persist, choppiness is high, and data itself changes very sharply. In a phase like this, you can see two things happen. Your churn can increase, or your decisions can get whipsawed. This has happened over a 20-year cycle. This has happened 4 times in the last 20 years. This can happen in the future. One needs to understand that active management, passive, and quant, all three are different. All three have their own advantages and disadvantages. When we take a quantitative approach, we are trying to add discipline, rigor, process, science, and a systematic approach to money management. We are not saying that this is free from error. We're not saying that this is perfect. This has a 60-70% probability of doing better. One cannot ignore the 30% probability of some months or some quarters of underperformance. One needs to understand that if there is excessive choppiness in the market, your portfolio could also reflect that choppiness. If there is clarity in the market, your portfolio will reflect that clarity, not just in returns, also in drawdown and volatility. We are constructing our portfolio from the market. Within the market, we use a set of factors that give us high exposure to quality, value, momentum, growth, low risk. In a certain cycle, these factors play out well. In certain cycles, factors don't work at all. This is a short-term phenomenon. Our efforts to control churn, reduce churn, are for investor comfort. Over a long term, high churn or low churn doesn't really matter. Net results, net of fees, net of cost, what kind of returns are we able to generate? What kind of drawdowns are we able to protect? What kind of volatility are we able to maintain? That is what matters. Whether I do it with a 10 stock portfolio or 100 stock portfolio doesn't matter. Whether I don't churn my portfolio for a year or whether I churn it every quarter. The tax differential is quite low. So over a long term, despite the tax on profits, you wouldn't see a meaningful difference in returns. And therefore, it is important to understand that we need to be honest to our strategy. Globally, quant strategies involve a high level of churn. In India, people are concerned with churn. We have to be authentic to the method of money management, which is quant, which involves churn. And sometimes your churn decisions work out well, like they did in the last 2 months. Sometimes they don't work out well, which they didn't in the month of Jan and Feb. So it's important to understand we keep trying our best to improve our models, take the right decisions for investors. We get it right sometimes, we don't get it right sometimes. But over a long cycle, our data and our live track record suggests that we tend to get it right more often than not. We've got a question of 30 stock portfolio. Okay. So quantitative investing is all about mathematical probabilities of identifying a set of stocks that can do well and constructing a portfolio that can fall less than the market if the situation were to turn. Our idea is not to take idiosyncratic risks. It is to take diversified risk across a factor group. We are not trying to concentrate on one sector, one stock, and show conviction of 5 years that this stock will do well in 5 years. We run an equal weighted portfolio. When you are running an equal weighted portfolio, you want bulk of your 30 stocks to do well, as opposed to 3 stocks where you've added very high weight to do well. Idiosyncratic risk is company specific risk. That is not a risk we are willing to take. We are trying to take factor timing decisions. We are trying to take sector rotation decisions. We are trying to take market cap allocation decisions. We are trying to take portfolio beta decisions. These are the decisions we are willing to take. These are the risks we are willing to accept. The decision which we are not taking is company specific concentration risk. In the past also, we've done well with a portfolio of diversified 25 to 30 stocks. Our back tests also suggest that 25 to 30 stocks portfolio is a good strategy. In India, we are still, believing that 20, 30 stocks is the right. Globally, quant funds run 50, 100, 200 stock quant portfolios. And that is why they try to manage risk and returns by factor decision, not by security decision. So it's very important to understand that as time progresses, as quant matures in India, you will not see 25, 30 stock portfolios. You will actually see 50, 100 stock quant strategies. That is how actual quant is done globally. Quant looks into management quality promoter background. Again, quant looks at fundamental red flags and quality metrics from a quantitative perspective. So quantitative models don't go and meet management, but they track a lot of data from cash flows to share pledges to promoter buying, selling, uh, to cash flow conversion, working capital management, leverage, interest coverage, margin stability, multiple quantitative metrics which give us an insight into the quality of the business, into the quality of the management, and into promoter pedigree as well. We look at it from a data perspective to decide if this is a high quality or a low quality company, if this has too many red flags or not so many red flags. Idea is to let data make the decisions rather than leave it to individual judgment and bias. We have a lot of active managers doing that. Active management and quant cannot be looked at with the same lens and should be viewed differently, should be treated differently, and should both be allocated to for the true diversification benefit. In a phase where quantitative strategies like ours and a couple of peers did returns between 55 to 75, largest, most popular active funds return between 25 to 35. So when there is clarity in the market cycle, quant funds lead. And that is the point I'm trying to make. That when you come to a quant fund, try to invest on the merits of the quant strategy itself. Don't try to find active management features in a quantitatively managed strategy. 6 months is a very short period. Even in 6 months, there were two outlier months which put us behind. The last 2 months, again, we are back in the top quartile in terms of performance. Uh, it's again very short period to judge performance. And the fund that you're mentioning, again, is an actively managed fund. You need to understand that if you compare a 2 year or 3 year cycle data of these funds to us, we are still significantly ahead compared to most of them.
What we need to understand, and that's the point that Siddharth and we're trying to make, right? Just don't look at the returns for investing into any strategy. Look at the processes in the system. In any sort of markets, which is already explained the different sets of the markets, you need to understand that if you give, we also invest in the businesses of the listed company. You need to give a 3 good year to your portfolio to mature and then expect a sustainable return. Having said all this volatility, good times, bad times, since we have just completed 2 years, if you see the live performance of investors in an entire strategy still in upwards of 26 and a half. So which also speaks about that you need to give your investment time to 3 years for that to play out. So the investors, those who have come in the first one or two quarters when the strategy started, despite of all these volatilities, they are still enjoying that kind of return. Is what I always want to see. If you are looking at a short term, equity is not a product. If you don't have a 3 years of mindset, trust us, the equity is not a product for you, because you will always have the uncertainties. You will always have some or the other things coming up. As we saw that probably when the Jan and Feb was slightly turbulent month for our strategy, then overnight I just can't go and rule that out. It needs time to play that out. And that time you need to spend. In market, only thing you need to spend is time. And then leave it up to the professionals to take care of that. Any further questions from investors? So if you have no further question, then probably we would like to wind up the call. Yeah, please. There's some investors just typing the message. I'll wait for some time till the time. See, there's a question related to so many stocks in the BSE which are low price and all. We are investable universe is top 500 by AMCAP. That's the first thing. And then we have our internal liquidity and fundamental red flag parameters, which again reduces or eliminates certain stocks, and then the final universe comes. So we try to generate returns or the alpha by, if as far as possible, sticking to the quality businesses and the quality management. When does one invest in quant? See, quant versus active. The whole thesis itself is different, is not correct. Why? Because you need to give money, as Siddharth rightly said, to either quantitative or an active asset manager for a period of at least minimum 3 years. If you have that mindset and the patience, you will definitely make much more ideas. When we had presented or when we started our strategies, we had already told investors that you'll have a 30-40% of time frame on a quarterly or an annual basis where you'll see the strategy underperforming benchmark. But when you have a long run, probably the strategies have completely outperformed benchmark with a sustainable alpha. We don't invest in stocks because they are paying dividends, sir. We invest in stocks because there has to be growth in the stock and the company for investors to make money. But obviously, in turn, if the companies are paying dividends, it's most welcome. We do have defense sector. We do have stocks in the defense sectors, which are currently also part of our portfolios. So there was a specific question related to the defense. Yes, we do have a defense stocks in our portfolio as we speak
And
today.
one more thing to understand, that neither equity markets nor quantitative strategies have linear returns, which means I could have a year of 10% return, then I could have a year of 30%, then I could positive, then I could have a year of 15% negative, then I could have a year of 75% positive, then I could have a soft year of 5% positive. Our idea is once you stay invested for a 5 year cycle, usually our strategy yields anywhere in the 25 to 28% sort of average return across cycles. That does not mean that every 6 months, if 25 is my annual average, that does not mean every year I do 25 or every 6 months I do 12.5%. Equity doesn't work like that, right? We have cycles where we build up a lot of returns and alpha. We have cycles where we give away some of that alpha. Again, we build that alpha. Again, we sort of lose alpha. Over a cycle, we compound with 5 to 15% range. And that is what our back tests have also suggested. That is what our live performance is also suggesting. Since inception, I'm 7.5% alpha versus benchmark. Idea is to stay diversified rather than chase fund momentum. Usually, what investors try to think, bulk of our AUM has also come like that. After 1 year of 78% return, people invested in our fund. 1, 2 bad quarters, people want to think that, oh, this fund is not performing. It doesn't work like that. Once you've done the due diligence of the strategy, once you've understood the process, you need to ride the entire cycle of that strategy through the ups, through the downs, through the good phases, through the bad phases. The moment you keep chasing fund performance momentum, you will keep getting whipsawed from one fund which did well in the last year. You will invest in that. Maybe next 12 months it doesn't do well, so you remove from that. Again, find the next fund which did well in the previous year. So instead of shopping and swapping from one fund to the other just to chase previous year returns or previous year fund performance, as an investor, you will never take money home. Allocating with discipline to active passive quant riding the entire 5-10 year cycle, that is what will make you chunky.
I think so. We have answered most of the questions which
Yes.
were there in
Yes.
Q&A box. But however, having said that, if you have specific answers, because there are some questions which are too much on a fundamental or a macro side, that we can obviously take one-on-one. You can call Siddharth or me at any given point of time, and both of us will be more than happy to take that question one-on-one with you all, or maybe over an email. And you'll. One very important question which has just come, that your view on the topping up of the portfolio. We strongly recommend, and that's always I have been telling during even my personal meetings when we meet partners and the investors, or probably when I address the investors. Please understand one thing, that in an equity, if you want a sustainable returns and a real long-term return alpha over benchmark, try and do your SIPs at the regular. And now we have a feature where the SIP can be auto debited from your bank account. So you can think of a quarterly SIP, monthly SIP, start topping up by say 5 lakhs every quarter or something. And you would always have, similarly, when Jan and Feb was bad, Jan, Feb, March was a bad quarter for month. If anybody would have topped up 5 months, probably May was up by 4%, June so far up by 2.5, 6%. So that 6% on that 5 lakhs is immediately made 0.3%. So this is how one needs to be committed, and committed with probably, you can look at even quarterly topping up by maybe 5 lakh, 10 lakhs based on what kind of liquidity you have available.
Even in our previous 3 webinars, when markets had corrected, when that time was great, we told investors use corrections to top up. So investors always wait for evidence that okay, markets have recovered 15%, now we will top up. Top up when things are bad, guys. Don't forget this rule.
Fair enough, Siddharth. I think so. We are end of
Yes.
majority of questions also for this. Thank you everyone for staying tuned. We are always available for any kind of queries that you have. Please call or write to Siddharth and me, and we'll be more than happy. In case you all want to understand, you are most welcome to our office also. Looking forward for such interactions in coming months as well. Thank you.